Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said, millionaires don't need astrologers, but billionaires do. And so we begin. Today is Wednesday, May 8th, 2024. Hardly any interesting data coming out this week as I've been talking about this week. However, Thursday there is an initial jobless claims coming out, and this has potential. It does have potential to rock markets if it's like very, very weak, much weaker than expected or stronger than expected. You know, we're still in a period where bad news is good news because it means lower rates, and yet, you know, really bad news eventually becomes really bad news. And this is why I continue to be so excited about treasury bonds as unemployment rates, as the unemployment rate is clearly trending higher and higher. We're just stepping up and up and up. It looks like we're set up for an explosion going upwards. But, you know, who am I? What do I know? I'm just the guy with the crystal ball. Anyway, next week we have our CPI and PPI data, which is more important information coming out. Onto the charts. This is a daily of the S&P 500. We opened and closed completely flat today. If you look at the little tiny green number at the top of the screen, it went down by 5 cents on the SPX, which is currently at over almost 5,200. And so it's less than 0.00% of a difference. I've been complaining, it's like there's no data. The markets are getting really boring here for the most part. But we still are in fear mode, according to the Fear and Greed Index at CNN. However, HYT says otherwise. HYT, this is my favorite leading indicator. I'm going to talk about it to no end. You'll hear about it a lot on this show. It's extremely important. This is default risk, bankruptcy risk that the market sees in more risky companies. And when this goes down, when the value of these goes down, it's saying very clearly and surely that there's trouble ahead, and this does not see any fear here. We are at closing high similar to where it was all the way back in March, in the middle of March, and before that we haven't seen it this strong since then. Of course, treasury yields do affect this with a 10-year note especially, and so as the yield goes down it does support this a little bit, but this is just looking strong here. This to me says risk on, at least for the moment. I think it'll be short-lived because again I'm seeing and hearing the real cracks now, you know, with unemployment ticking up, with companies coming out with saying, hey, we got lower guidance ahead. You know, people are borrowing lots of money with credit cards. The consumers being, even Walmart, like, started it all, like, months ago. The CEO came out and was saying how, you know, look out, people, the consumer is weaker here. And so I really think this is it. I still, even though I see HYT as being my favorite leading indicator showing strength right now, again, I believe this will be short-lived, and I don't believe we will see a new high in the S&P 500. The way I'm personally playing all of this, I'm not going short the S&P 500 or anything right now, but I have basically the equivalent of a 50% exposure to long treasury bonds, which should perform well when earnings continue to contract and unemployment goes up and all of that, because yields will be forced lower. In the meantime, it seems like the S&P can go higher than here. I don't think it will go higher than this previous high, but that's my crystal ball reading. So moving on to the VIX, this is the pricing of options contracts. When this goes down, again, it's just showing low fear here. Gareth Solway on his show said he's actually buying the VIX here. My crystal ball is not clear enough for me to be able to be confident that the VIX is going to be going up from this point. I don't see any reason I mean, he's better at drawing these little trend lines than I am, but you know, it's I need I need a little bit more evidence on all the charts combined for me to consider going short or going into the VIX. You know, these things are, you know, it's way easier. Like I've been saying before, it's much easier to do well by going long, by buying something cheap and having it increase in value, than to buy something and hope that it goes down in value. But or by shorting. Shorting is very hard, and you have to be very careful. You have to be sure, like 100%, thing is going to happen, uh, and and that's how you do it. Speaking of which, I made a great call on uranium yesterday. I said I wasn't going short here, even though I mean, I don't even know if I know of I'd have to find a fund. I'm not even sure I'd find a ETF that shorts it. And I don't short things directly. I don't even have a margin account, not yet anyway. But so I was pointing out how we had a higher high in uranium, actually on Monday, and then it went even higher on Tuesday. Had I gone short Monday or Tuesday, that trade would have played out very successfully today. We did end up closing below Monday's entire green candle here. And so this looks again like it's going to continue to be bearish here. And I pointed this out, the RSI was lower with a higher high in uranium both Monday and worse on Tuesday. Had you gone short in any of those spots and you couldn't get out today, and this is simple, just RSI, and this was a beautiful chart right here. If I was a day trader, which I am not yet anyway, I would have taken advantage of this and I would have done well. That's all for today's show. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.